Insurance. We have a number of participants already joined in and many more joining in. Welcome to all the participants who have logged in for the Marsh webinar, COVID-19 Impact and Claims at Trade Credit Insurance. We have 54 participants already logged in, and we expect many more to join in as we come close to 4 p.m., 5 p.m. Friends, welcome to the Marsh webinar on Trade Credit Insurance, COVID-19 Impact and Claims. It's 5 p.m. and we have close to 8, now touching 90 participants already registered. We'll start our webinar in less than 2 minutes. Friends, it's 5:01 and we have 120 participants registered. So we'll kickstart our webinar on time. A very warm welcome to each and every participant. I'm Sanjay Kedia, Country Head and CEO of Marsh, welcoming you all to the Marsh webinar on Trade Credit Insurance, COVID-19 Impact and Claims. During the entire webinar, you will have an option to raise any question and answer you may have for the panel member. You need not wait till the end to ask a question. You could type in your question at the below. You have a tab on Q&A. Do not use the chat option, just use the Q&A option, please. And if you want to speak, please raise your hand also, which is again provided in the participant option. Next. We have a very impressive set of panel members today. and we are very pleased to present the best of leaders of the Indian market on the credit insurance. We have the country head and CEO of Atradius India. We have the Mr. Arun Sundarajan. We have Bhavesh Patel, country head and CEO of Coface India. We also have the largest player in the Indian market of ECGC representation by Mr. Subhash Chahar. He leads the large export branch, and prior to that he was leading the claims also, so he has a tremendous experience to talk from ECGC perspective as well. And we have the leading credit risk management and the debt collection company in India operating M&S credit management leader, Dr. Seema Kumar. And we have Marsh experts, both from the region and our India leaders. So from the region, we have Eddie Feather, who leads our claims based in UK and Ireland. And we have Tyler, who leads the Asia Trade Credit Insurance practice based out of Hong Kong. And we have Akshay Bhardwaj, the leader for Marsh India for the trade credit insurance. So we have a big panel, lots to cover, and we will be very happy to take question answers. A quick remark, Marsh India has been organizing numerous webinars around the most topical risk issues. And as we all know, COVID-19, which was essentially started as a health crisis, turned out to be a bigger economic crisis. And when we look at variety of risks which are becoming bigger with every day passing, be the risk of globalization, employment loss, long-term recession, and so on and so forth, the bankruptcy and the credit risk is very much staring across the globe as a very real issue. And credit insurance as a potential solution provider is very much on the ask. We also have insurance regulator, IRDI, taking the proposal of allowing the use of credit insurance for the banks as a beneficiary. They are in the last leg of making that announcement. They've already issued the final consultation paper out. So we are pretty excited how credit insurance can help manage and mitigate this and be a partner in different firms in managing this critical risk, which is emerging out of COVID-19 and otherwise. So with all this, I hand over to Akshay. He would be leading the entire coordination of today's webinar and managing the best show. So over to Akshay, and I hope we have a good session.
Thank you, Sanjay. And thanks a lot to all the participants who have taken out time joining this panel discussion.
We have 162 participants now, which is good.
So basically the agenda for today's panel discussion is we'll be talking briefly about trade credit insurance. And I know you're not here to understand trade credit, but more in terms of getting answers for your queries, which will be taken into three forms, that is pre and post-COVID world, how things are changing in trade credit insurance, which are the important sectors, cautions, which are very important, which will interest a lot of participants. We'll be talking in detail on collection and recoveries, not only in India, but globally. And also a very important topic, which has been asked by a lot in terms of what has been the impact of IBC, that is Insolvency and Bankruptcy Code Act actually now, and the new proposals which are coming from government. So that would also be on the platter in terms of discussion. So please feel free to ask as many questions as possible. Can we have the first poll question, please? You may please select your option and submit. Thank you. I think the purpose of having this seminar makes immense sense because we are seeing almost 85% of the participants talking about the concerns, the largest concerns in the COVID world on cash flow. So here it is, trade credit insurance. As you many are aware, trade credit insurance is as old as trade is. But predominantly it got its recognition post World War II in supporting not only domestic trade but global trade. And but as we look today, the situation almost everywhere is the same as it was probably in World War II, where businesses are getting closed. Uh, the world powers, if you see, they are bickering. A new debate has increased in terms of being having a globalized supply chain or a localized supply chain, and trade in general has come to a standstill. Marsh, which has always been at the forefront, being largest broker, we have had so many queries from people, and hence we thought that rather having a only webinar, which we have been doing earlier, we will have a panel discussion where we get the industry leaders to answer your queries. Coming back to trade credit insurance, as you are aware, trade credit insurance is considered the backbone of trade receivables as well as trade finance. If you look at coverage, it's a very simple cover that way, which covers insolvency of the buyer, protracted default, and political risk in case of a cross-border business. In terms of exclusion, you will see that we can break it into 2 or 3 parts. There are very minimal exclusions. One is mother exclusions, which is like for war between 5 superpowers and nuclear perils. Second is with respect to performance, where trade credit insurance covers the risk, credit risk of the buyer, and not your or the seller's performance risk. And third is important in terms of setting up the tone of the product, where it covers B2B solutions, and the buyer should be a business entity. There has to be a commercial transaction, etc., etc. We can delve further on it, and we can have a small. So this is just a slide to give you a perspective of how trade credit insurance helps. It provides financial protection against default due to insolvency, protected default, and political risk. Credit insurance also acts as a tool to benchmark your risk, wherein a third-party insurer assess your buyers and tell you what is a good exposure which you can have. Third, it helps in market expansion, where today, which is one of the biggest challenges with companies finding new buyers and safe buyers, and trade credit insurance can actually help you pick up the right buyers and take right exposure. A very important aspect of it is that it in general enhances the overall buyer portfolio. Trade credit also helps in debt recovery. And with IDA looking at it very positively, we believe once this is done, globally, all trade finance is backed by trade credit insurance, and that would be a reality soon. Now, going back, or can we have the second poll question before we move to the next slide, please? The question is, because of supply chain disruption and lengthy lockdown, are you witnessing the default and insolvency in your business? There seems to be a confusion between agree and strongly agree. And okay, almost 90% of us are facing this situation, which is understandable because we have been getting similar feedback. Moving on, this is what I picked up today from the Wikipedia page on terms of what impact of COVID had been. There had been 12 million cases globally with almost 500,000 deaths. And in India itself, it has been 0.7 million cases with almost 21,000 deaths. The point which I want to make over here is that in 2009, when we saw a global financial meltdown, at that time, global economy was about 45 trillion, and the economy shrunk only by about 0.1%. Today, we are talking about a $90 trillion economy going to shrink, and people have no number between 6 to 7. Some are saying 8. So everybody has got a number, and we can pick how optimistic or how pessimistic we are. Plus, there has been a double shock in terms of demand and supply. But since it's a topic of my interest, I can go on, but rather we will hear from the panel. So my first question goes to Mr. Arun Soundarajan, country head at Radius. Sir, what are the top 5 parameters which are important for you when you decide on a commercial or premium of a program?
Thanks, Akshay. It's a good introduction. I'll come straight to the point. You asked me what the top 5 parameters were. Essentially, what we look at is the turnover size. We look at the sector, of course. We look at the quality of buyer risk. We look at past losses, if any. We look at aging. And we look at the general DSO credit terms and control. This is traditionally what it used to be. Post-COVID, it's still the same. However, there is a slight order of priority. My first parameter I would look at is the quality of buyer risk. Irrespective of what the turnover is, I will certainly look at the risk acceptance and the quality of buyer risk. That is paramount. I will definitely look at, if possible, the quality of their credit control process. Sector, of course, is a dominant one because we have certain sectors that at this point in time we'll be constrained not to do. And generally they're aging. So this is in very, very broad terms what we look at in terms of how we decide on a premium.
Thank you, Arun. Subhashi, you are heading the largest exporter branch of ECGC. Any comment from your side as to how you decide on the premium? So our clients are clear when they're approaching you what to expect.
Yeah. So for us, the major deciding factors, parameters are the country, destination market, where the goods are being exported, and the credit period which is extended to the buyer, as well as the type of risk which is being extended, whether it's whether the client wants comprehensive risk coverage or it's only political risk coverage, and whether the business being offered is only a selective segment out of the entire portfolio or the entire portfolio. So that also determines the premium cost for the credit insurance cover.
That was from ECGC. Thank you, sir. Tyler, I think this question, the next question would be well suited for you with your vast experience globally. See, we all are seeing, and this is no news, but after the COVID strike, what we have seen is that the premiums have gone up. And one question which keeps on coming from our clients is how to decide between self-insurance and credit insurance, whether they should remain self-insured or should they opt for credit insurance. What are your views on the same?
Thanks, Akshay. So, I mean, it's a very interesting question. To be honest, we don't really hear that much from clients at the moment in regards to inquiries or conversations about self-insurance if they are currently insured at this time, given the current economic climate and obviously the foreseeable future for the rest of this year and probably the first half of 2021 as well. Rates are going up. We have certainly seen that in the last 2 to 3 months. And will continue to probably increase a little bit as we go throughout this period as well. Why is that occurring? So it's a combination of things, really. The insurers themselves are seeing an increase in a very substantial and significant increase in the number of claims and past dues that are being filed. And also their cost of risk, their own cost of risk that they're getting charged internally. And of course, their reinsurance costs are increasing as a result of the increase in claims and past dues. I think the interesting part that we're going to see is obviously there's a substantial increase in past dues filed, not only in India, but elsewhere throughout Asia as well, as soon as countries entered lockdown. Now, most countries in Asia have emerged from lockdown. Some second waves have occurred to an extent. So it'll be interesting to see how many of those filed past dues have now or will be paid down in due course under repayment plan as cash flow starts to ease up and improve during those next couple of months. So I think we'll have to wait and see how that plays out. But the reason we are seeing rates go up is really around the cost of risk and the reinsurance costs that are being incurred by the carriers now.
Thank you, Tyler. So what I understand is that obviously the cost is going up, and you would not advise in current uncertain time for a client to remain self-insured, rather look at credit insurance as a tool because of the host of benefit which it brings in. This question actually goes as a supplementary to Bhavesh. Bhavesh is head of CEO of Profas and have had experience of an insurer, reinsurer, broker, so very vast experience. Bhavesh sir, what would your suggestion would be for a client who is indecisive between self-insurance and credit insurance?
I would concur with what Tyler already mentioned, and in fact, I would submit to all the participants that the answer lies more within yourselves. Pre-COVID, yes, I mean, it was your philosophy on risk management. I mean, how positive your cash flows were, what were your mode of sales, etc. There were various factors which could have, led a potential corporate to go for self-insurance. But I'm saying post-COVID, can anyone predict how the next 12 months are going to go? There is already an increase in, overdue and aging positions. As Tyler already mentioned, we are seeing a lot of, claims. There's a substantial rise in insolvencies. Uh, we at COFAS in our last Q2 economic analysis, which is a public platform document, we have already, the predictions from our economist side is that, there's going to be a 33% increase in global insolvencies, So, I mean, it's a question of today, survival. It's not about just, how better we can manage our credit risk.
Nice point, Bhavesh. I think what you are saying is that it is not a choice actually. It is more in terms of, so philosophies are good, but in times like this, it makes sense to have a professional taking care of this. And before you leave, I would want one more question from you, and that is, if today I ask you, okay, Bhavesh, these are the client, or this is a client who's looking for insuring themselves, what would be your top 5 sectors where you're comfortable currently? And this is meant to make people understand how you are looking at this.
Um, I would say that, comfortable sectors today, I mean, we look at all sectors in a way, but obviously there is less risk appetite in certain sectors which are really, really badly impacted by the pandemic crisis, currently. But some sectors which clearly have not been impacted so much by the pandemic and can have some more positive outcomes are, sectors like pharmaceuticals, for example, uh, all essential food, FMCG kind of stuff, and anything which is key and essential in nature. So what is non-essential in nature is going to get impacted. So I would answer it this way, that we will be more comfortable in sectors where we clearly see, based on the 5 rating factors which Arun spoke about, where we don't see aging, where we don't see claims, where there's no past record. We will always be willing to look at these sectors.
Thank you,
But
Bhavesh. Arun,
yeah.
would you like to add something to it? Any specific?
Yeah, just
Bhavesh
one
just
specific.
dodged the question.
Yeah, just one. No. I'll go to the particular sector and say, hang on,
Yeah.
why didn't you do my next prospect? Okay, I don't want to get into that. Okay, the fact is that I will probably look at where there are large dependencies between the buyer and seller, where there is a little likelihood of the buyer defaulting with respect to what he's bought. It could be a product or a service. So I'll go to that extent to just tell that dependencies are a dominant factor, both in the market and the buyer seller.
Yeah. So, Subhash, would you want to add anything, or maybe you can take it other ways, that if you're not comfortable with certain sector or being government organization, you may not want to get into this. Subhash?
Yes. Can you hear me? Yeah.
Yeah.
So I concur with what Mr. Bhavesh has mentioned and Mr. Sundarajan has also mentioned. There is a sector, diamonds and jewelry, GJD sector, where we have had tremendous amount of claims in the past. So as of now, we are not comfortable in with this sector as much as we are comfortable with sectors like pharmaceuticals, agrochemicals.
Correct. No, thank you, sir. Okay, so moving to the next question, and this goes to Eddie and then Tyler. This is one question which has come to us again and again when we pitch trade credit insurance. And Tyler is also my boss, and he sees my numbers and he knows how world is happening, how things are happening. So Tyler, this question goes to you and Eddie. Why trade credit is more popular in Eurozone and Americas vis-a-vis Asia?
Tyler, should I comment?
Yeah, please go ahead, Eddie, and I'll follow up on your point. Please.
Okay, I'll sort of state the obvious to start with, that the fact that it's been around a lot longer in these territories, credit insurance, and it's come out of 2 world wars. When governments helped to improve trade credit through government export credit agencies, the whole of trade. This then has been developed further and been taken on by private insurers nowadays. And nowadays, credit insurance is a multi-billion-dollar business with billions of dollars spent on premiums and billions on claims. To try and give you a bit of a feel for this, as a result of COVID-19 and probably Brexit, the Association of British Insurers, with credit insurance group, has quoted that in a worst case scenario, something in the region of £1.2 billion of claims are expected or could happen in a worst case scenario, when usually year on year it's around about 300 million. So that's a 4 times increase.
Huge.
And I would just say that credit insurance has saved many companies from going to the wall. And I've got a couple of examples. I recently dealt with a case where it was a company that had a turnover in less than £10 million, who suffered a bad debt on British Steel. And the company was under significant pressure from its financiers. And this bad debt would have sunk them, but they received a claim payment of 1.35 million from their credit insurers, and that's helped them survive. And another situation, probably a very extreme one, is where the largest claim I've ever dealt with, which is only a short few years ago, resulted in approximately $200 million claim payment to a client. Now, that wouldn't have sunk this client, but a lot of jobs would have been threatened.
No, thank you, Eddie. I think what you meant to say is that this has stayed long, and there's a lot of government intervention to support trade by trade credit insurance. India have recently opened up to global trade, and probably this will still take time. When I meant Asia, most of the countries have been doing more of intergovernmental trade. Tyler, you have anything to add? Why?
No, thanks actually, and thanks Eddie for a comprehensive answer there. Just to follow on from a couple of Eddie's points. So, yeah, I mean, historically, really, Eddie's spot on. So, if you have a look at the countries that spend the most in terms of gross written premiums, where the policyholders are based, it's the traditional countries in Western Europe where credit insurance was developed over 100 years ago. And has grown quite rapidly in that time, supported by international trade. So the likes of the UK, France, Italy, Germany, Spain, Netherlands. Penetration rates of the product of short-term trade credit insurance in those countries is approximately about 45%. If you compare that to Asia as a region, the average penetration rate in Asia is less than 5%. In somewhere like China, it's less than 1%. So it's a very immature product in Asia. It's the multinational or international carriers only really started to come to Asia and invest more heavily in the early 2000s. So we're talking less than 20 years by comparison to the 100+ years in Europe. So it has grown rapidly. I think it's grown very markedly in Asia in the last 10 to 15 years, and will continue to do so. And growth levels here will be exponentially much larger than they are in Europe. And also the carriers, the international carriers, where they're investing most heavily is in Asia. That's where the growth is.
No, thank you, Tyler. I understand. I believe it has to do more with it's just a 15-year or a 16-year phenomena in Asia, and probably as things will grow, it will grow deeper. And I think COVID has also created a lot of awareness about it. Now, I think in our first part of the discussion, we have covered a few questions over here, which are there, like how things are changing in important sectors. So I would come to another question, which is a very important question, which are being asked by our client. And this is where I would reach out to the insurers over here. That is, what is your caution? And what would be your advisory for your sellers in these times? Maybe you can start with probably 2 best advisories from your side so that everybody can contribute. Bhavish sir, would you want to take this?
So I think it's a very simple caution and advisory. Times are bad. So be very careful in managing your overdue positions. And it's not about sales anymore. And for the very purpose for which trade credit insurance is there, so you have to ensure that it's protected sale, insured or otherwise, in a sense. because this is the time to restrain. This is the time to be very careful of what calls to take on based on the debtor risk profiles, because unless you're very sure of where his cash flow positivity will be also maintained, and how logistics and supply chain disruptions whether they impact him or not. So some people will have to now really, as a seller, look into, otherwise you'll convert yourself into a pay when paid kind of a situation. Then that's what we are seeing also in a lot of increase in the overdue positions, and
So,
especially countries like India, where we have had such an extended lockdown which still continues, and it really becomes challenging. So I think the time is for caution to concentrate more on bottom line and not on top line.
So two things which I understand from you is, one is buyer profile is very important, and second is that one should not go very aggressively into the market, rather being very choosy about their buyers, and continuously aggressively follow for a due becoming an overdue. So these are 2 points from you. So Arunji, can I quickly have your 2 points?
Yeah, so
as
my
advisor?
2 bits would be pretty much on the same lines. As far as the policyholder side goes, I think you should look at doing sustainable business, not relying totally on the insurer to do it in a claim payout. Secondly, he has to also look at his trade vis-a-vis his exposure. So he should not be in a situation where he overexpose himself. Voluntarily, he should probably look at a deep, hard look at how much of business he's going and how much of limits has he actually got. So doing sustainable business, trying to control exposure, and obviously beefing up the his own credit control processes. And these 3 would be my...
Thank you, Arun. Thank you. Subhashi, you have any other 2 points which you want to add to this in terms of your advisory to clients? Apart from one thing which you keep on telling is that the paperwork must be perfect.
Yeah, the paperwork is no doubt goes without saying. But as Mr. Sundarajan said, that quality of business is more important than the quantum of the business. So here, post-COVID, we have to concentrate more on prudent selection of the buyer and more prudent business doing.
Thank you, sir. I think so. So buyer, quality of buyers, going slow, very important. The documentation has to be in place. Quality of business, rather quantity of business. I think these are very important advisory to our clients. So I believe our clients will be looking at it. The next question goes to Tyler and Eddie once again. This is very important, and I think insurers would not want to answer it because it's pretty tricky. Is our clients are asking that limit exposure is being reduced, especially post-COVID. Underwriters have relooked their exposures on buyer, but they are also asking, are the claims being paid? And who better than Eddie, who is living claims every day? Eddie, your comments? Are insurers paying claims? Eddie, you're on mute.
Thank you. Somebody was going to do that, weren't they? It's bound to do it. I've just a bit of background. I've been trying to compare the current situation with the financial crisis of 2009-10 and what we can sort of expect. So in 2009-10, we experienced almost a doubling of claims in comparison to what was taking place last year for our clients in the UK and Ireland. And although governments have provided extraordinary support, really, my crystal ball just cannot see past the fact that this is likely to be worse than the financial crisis in terms of claims numbers in my region. In discussion with insurers, their expectations have varied between a 40% increase and up to 100% increase on claims that we've seen. So, but really going back to your question about how insurers are going to behave when they're inundated with claims, well, in the past 10 years, my team has dealt with something like 10,000 trade credit claims, where hundreds of millions of dollars have been paid out. And as an indicator, the average claim acceptance rate year on year by number of claims is between 96 and 98%.
That's huge.
Well, it's good.
Yeah, really
it's good. So in regards to the current situation, when I've talked to insurers, and this won't come as a surprise, they've all been saying that they've got no plans to change their processes, which is exactly what we'd expect them to say.
Very possible.
However,
so can I take this inference? Sorry, to cut you, but can I take this inference that yes, the limits are being reduced, but wherever insurers have agreed to take an exposure, they are honoring the claims?
Yes, from my point of view, the point I would say is that insurers pay valid claims, and it's really important at the end of the day for clients to remember to ensure that they're familiar with their responsibilities and understand their policy, to ensure that they adhere to their policy terms and conditions and not jeopardize their claim. And if you're in a very challenging situation, speak to your Marsh contact who will help guide you through this process. These are the keys for me. And on that basis, you'll have a valid claim and it will get paid. That's been my experience.
Thank you, Eddie. Tyler, you want to add something? This is your global experience with insurers and you're looking at a wholesome picture. Are the claims being paid?
Yeah, I mean, I'll just touch on one point actually, just in terms of limits being cut drastically. There are limit actions. I think when limit actions like this do occur, it obviously has a very profound impact on our clients, quite understandably. But I think there's a little bit of perspective as well, because from what we understand and from what we're experiencing and what the underwriters are telling us as well, the reductions that are taking place, it's only approximately, give or take, around about 5% of their total exposure globally. So for instance, a leading insurer globally has close to, or had close to 1 trillion euros in coverage in place before the onset of this crisis. So you take off 5% of that, there's still a huge amount of coverage that's actually in place. So moving on to your point about, and following up from Eddie's sort of quite accurate and astute answer on insurers paying claims, it's the product's reputation is always at stake, and we have found, and to Eddie's point as well, the experience has been that insurers have paid a vast amount of claims to a very high percentage, where less than 3 or 4% of the total claims that Marsh actually deals with are declined or rejected in some form. And most are declined on the basis of very obvious ways in which the insured didn't adhere to terms and conditions of the policy, such as timely reporting of the claim, timely reporting a repayment schedule, having it approved by the insurer, etc. So insurers have a reputation, credit insurers have a reputation for paying claims promptly and for paying vast amounts of claims as well, and denying or rejecting very few of them. And we hope that that will continue during this crisis as well. I mean, it's obviously we'll have to see how it plays out. But again, the reputation of the insurers is at stake. And I think, again, not to sort of delve into too much detail because it doesn't really impact India, but the fact that the state reinsurance schemes are coming into effect in Europe, where the vast majority of premiums are underwritten, that will obviously soften the blow, the financial blow, and obviously the claims blow for the private market insurers as well there. So that will obviously be of great assistance.
I think this is, thank you, Eddie and Tyler. I think this was a very important question because people were asking about it, that whether the claims being paid. But when you say that almost 93-94% of the claims are paid, and the claims where they are not being paid are because of obvious reasons, we have invested heavily on this. And I think Marsh being the only broker with having such a vast dedicated claims desk, like Eddie is there, Manish is there, we have a desk in New York. And the whole reason is to ensure that when the time of a claim comes in, we stand by them. But it is very comforting for prospects and clients when they come to know that, okay, even a claim will come, the hit rate is pretty high. Moving to the next portion of it, can we have the third poll question, please? Which sector, in your opinion, has been most severely impacted by COVID?
Sorry,
Yeah, so it says construction infrastructure takes the top spot, followed by textile and garments, followed by consumer durable and FMCG, uh, followed by engineering. Uh, and I think this is something similar to what we have been experiencing with respect to our client focus. And this brings us to the second part of it, that is focused on collections and recoveries. We have with us Dr. Seema. She is head of MNS, which is India's largest debt recovery agency. Seema ji, this question goes to you. You have been in this business for years and years. How has COVID era changed the debt collection? Would you want to share with us some few key points per your experience?
See, we all know the COVID era and the lockdown has really changed. The recoveries have definitely become more tougher now than ever before. And the most important thing is the site visits. You used to have site visits. Our legal teams used to go meet the debtor companies, have a face-to-face meeting, which is stopped. Even the companies who have now even started their operations, they're very reluctant to meet. And they're making excuses that due to this, we're not going to meet. Further, they're making excuses for non-payments on the grounds that we have the stock lying with us. You can come and take back the stock. The value is there. The value. Rates have gone down in the market. That's a big challenge. Though the number of cases have drastically increased in the last quarter, there's no doubt about it. But the recovery has dipped to around 50 to 60% what we are doing it. Whereas in the chemical and pharmaceutical sectors, we're pretty happy. The recoveries are coming very good for the reason because this is one sector where they really want it, as the previous analysts have also said. Now, most of them have the liquidity crisis. Then there are a couple of cases where people are not willing to take the goods. So it's a challenge for us to recover the money. And there was always a fear we could have done NCLT. Now NCLT is practically out. So there is a moratorium there. So we cannot actually do that also. People have not really worried. So these are the main
I'll come to NCLT separately. We have a separate session on it. Yeah.
So,
yeah, you're saying something. Sorry.
So these are the main points.
Correct.
Visit restrictions, not issuing legal notices, liquidity issues are coming up where they're saying we've not been able to sell the goods. We have the stock lying with us. You can take back the goods. Then a couple of companies don't even have the funds to restart the thing because they say we cannot operate. We don't operate. How do we repay the debt? Then there are a couple of places who are not even willing to take the goods. They have not taken the shipments, especially the cross-border ones. They're saying prices have gone down. There's no, so we have actually in a couple of cases changed the terms also from DP to DA with the comfort letter from the bank as well as an undertaking on even shared the cost of the pricing of demurrage retention charges plus decrease the price also so as to minimize the losses. This is the main thing where we've had problem. Now,
so what I understand, and I always say this whenever we are talking to our clients with respect to trade credit insurance, we say that debt collection is the integral part and the backbone of trade credit insurance. And I remember in one presentation where Arun was posting about that their pre-indemnity debt recovery is as high as about 50%. And I think obviously it comes from you guys who actually go out in the field to collect. Arun, what are your probably experience in, maybe if you can give 2 or 3 key points other than what Seema has mentioned in terms of what has changed in debt collection in COVID era?
Quickly, I'll just not reiterate. I think the challenges here are the people. There are 2 things. One is that people who have been giving money on time have a genuine cash flow issue. I think the key is to engage with them far more better than earlier. The second is there are some buyers who probably are taking advantage and want to ride the gravy train because they know that if it goes to the court, they'll probably have buy time for about a year. And NCLT is really not working that effectively. You can't even define what a COVID debt is. So some people are trying to ride the gravy train, but most often than not, we find that people are genuinely coming forward to engage. And that's been my experience. So there is a world of difference in terms of collections per se, but I think the key thing here is to engage far, far sooner than what we used to do earlier and give it to the recovery agency.
Yeah, so what I understand is that the moment there is some overdue, probably as an insurer, you would want to immediately engage to ensure that the recovery percentage goes up. The next question actually goes to Bhavesh, who with COFAS have one of the first in-house debt recovery team, and we have seen them coming out with very unconventional ways to assist recovery. Bhavesh, any specific point you want to mention how you are coping up with this situation in COVID era?
Yeah, thanks, Akshay. So yes, we have, as the market is aware, we have been getting in touch much earlier, and it has proven to be a very successful thing pre-COVID times. Post-COVID times, the challenges are the same as what Seema and Arun have already spoken. Actually, the lockdowns don't facilitate. See, a lot of things what can be settled across the table or in meetings, is not possible over phone calls. And then there are also a large portion who are, as Arun used the term, grab the gravy train or board the gravy train. So basically, people are correlating the government extension of moratoriums on GST or on bank interest or on loans, etc., with the same thing out here, that yes, since the government is allowing everywhere, even we will also only pay when our business comes out of lockdown, etc. So the challenges have been more lockdown basically, and I think
If I ask you in COVID era, what has been, if I ask you an objective percentage? So if earlier the recovery was, say, for 100 rupee debt, your percentage was 60. In COVID era, how much it has dropped?
So yes, for us, we used to always be in the 50-60% range normally, ideally, and today we have, I think dropped down to about half of those levels, you can say approximately.
Okay. Seema ji, any percentage you want to give?
As I said, the cases of numbers have become double, of course, but percentage-wise, it's gone down by 60 to 70% in some of the sectors, except the pharmaceutical and chemical.
Arun, any point from you? Any number?
Early days, but we're just seeing a lot of notifications of overdues coming through. And as far as recoveries go, yes, at least it's not as effective as what it used to be. I think
almost half. Almost half.
Almost half. Yeah.
That's scary. So, if I ask you, what would be your 3 advices to our clients to ensure that when a claim comes in, the recovery is effective? Just 3, because we are losing on time. So, I have one more topic to cover. What would be your top 3 advices to our clients to ensure that when the recovery or when somebody defaults or delays, the recovery is effective? Starting with Seema ji.
Okay. The most important is try and take a debt acknowledgement. First, secondly, if there is a proposal from a buyer, please accept it fast. Don't take very long. The more you delay, the more the chances are the recovery is going to be. So if they're giving you installment plan or a discounted or term change, do it fast. And then if you have another thing, if there is the most and foremost thing is assign the case to a DCA and take trade credit insurance. You won't keep on waiting, because it's not that it's better to rather outsource any unpaid invoice too early than rather than too late. Because in the next 24 months, if it's all cash, effective cash. That's the most important thing.
Thank you. Arun, any new
points? Just one word of advice to prospective clients or clients. Don't take a stand that, oh, it's all or nothing. We don't want the money. We'll go all the way to the battle on the courts. It's absolutely important for the negotiation process to start. So I think that's the key.
Bhavesh sir?
I will say only one thing: move fast. Anything which is 60 days overdue, please start going deep diving into it. Simple.
Subhash ji, any specific point you want to make?
All points have been made. Time is of essence. Time is of essence. So you have to.
As you always say, paperwork should be strong. Time and should be flexible. Eddie, any comment from your side? This is a very important aspect. Everybody wants to know because everybody is facing overdues.
Yeah, just one thing to make absolutely clear. If you're going to get into some sort of proposal or repayment plan, just make sure you run it past the insurer first. Otherwise, you could jeopardize a claim. It's really critical that the insurer.
Very important. Very important. I think. Yes, I think this is bang on. This is bang on because we have
There are a
seen.
couple of other things I would say. I was looking at this whole situation pre and post bankruptcy. Pre-bankruptcy, I was going to go back to basics. You need really good, clear documentation and communication to make the process easier for everybody. So that for me is all about clear terms and conditions, so each party understands its obligations, along with copy orders, copy order acknowledgements, signed delivery notes, and copy invoices. Now, that may not be possible in some territories, in some situations, but those things I think are key critical. Then moving on to the bankruptcy side, obviously you've got, ideally, you've got some sort of guarantee or something for, a personal guarantee or something like that, but you usually don't have that. But certainly in Europe and in many regions, what they do have is retention of title.
Yeah, they're very important.
Or,
very important.
so retention of title and where we are in the UK, all money's retention of title has saved millions of pounds for insurers. And it needs to be in your contractual terms for the appropriate market. And in some cases, insurers absolutely insist on it being in the terms. So I'd just make those sort of points at the moment.
A very important point. I think this is what the whole purpose of having this seminar was. Moving on to the last phase, because we are also running on short on time. Can we have the next 4 questions, please? There are 2 actually. The first one is Insolvency and Bankruptcy Act 2016 was implemented to improve collections and recoveries. Has it been successful? Options are agree, strongly agree, disagree, strongly disagree. The fight is between agree and disagree. There are no strong opinions. Almost 50% say agree, 49 rather, 51 say disagree or strongly disagree. So there is a tie actually between agree and disagree. Next 4 question, please. No, this is 4th one, I think 5th one. Yeah. Recently, Government of India, as many of you would be aware, have sought feedback of from stakeholders on their view how to decriminalize 138, Section 138 of Negotiable Instrument Act. Do you think this should be decriminalized? Okay. Immediately, I got almost 84% saying no, it should not be decriminalized. 77. Okay. I think this is so almost 79% says that no, it should not be decriminalized. Section 138 should remain. And I think this is where comes our next question, next phase of the last phase of our discussion, that is with respect to the impact on claim. And I would invite Seemaji, we will have a very short time, so maybe we'll try to be quick. Seemaji, how successful was IBC in debt recovery since it's...
IBC was very, very successful. Whatever your poll says, that's a different thing. Even the statistics say for financial secure creditors became 20 to 42% in 3 years only. So there we say 50% recovery had increased for financial. For operational creditors also it was great because there was a lot of pressure on the buyers, or the defaulters. Even if there was some threshold was initially 1 lakh. So with the, even we had 5 lakhs, you just issued a notice and they used to pay. So they didn't want to go into insolvency proceedings. Now with this going down, the threshold increasing and all, definitely it's going to impact.
Yeah. So this recent change which has happened in IBC on increasing the threshold from 100,000 rupees to 10 million, does that, how do you think that would impact?
See, the 24th March, the government gave the notification that no, now it's going to be, instead of 1 lakh, it's going to become 10 million. So because one crore, that's 10. Now, because of this, what the problem has started is the smaller claims which are there for 50 lakhs or something, you don't have this option now. So there won't be too much of pressure because NCLT there was a lot of pressure. And now on this, the reason is that once the pressure is less, there's no urgency because the other options are pretty simple. They're time consuming and it's going to be very costly. So So people don't care for that. NCLT was a very good option, but moratorium is there, so obviously it's going to be for a year now.
Okay. Sivaji, last question, and I think we will open the question answer line because we are just 7 or 8 minutes left now. This is about a bigger concern which we are facing among our clients is with respect to this proposal. Now, it has not yet been accepted, but and you have seen in the poll as well, that people want check bouncing being criminal offense. They want it to remain for the simple reason that it increases the chances of debt recovery tremendously. What are your comment, and do my clients have some sort of a remedy if it is decriminalized?
There is definitely the section 130. If it's decriminalized, the effect is going to be really bad on the recovery sense, in the sense because there's always a pressure on the check giver buyer that, oh, if my check bounces, there's a criminal, I might be imprisoned up to 2 years, or there could be fine. So there's always a criminal pressure that the police is going to come, there's going to be bail, non-bailable warrants and all. But then if the government decides on doing it, we have other options. It's not that this is the only option. We still have an option under section 420 that says it's cheating to some extent, but that depends on the case to case. And then we have commercial courts which are there, which are also, and the summary suits are there. Summary suits are pretty fast. The way the name summary says, they're really fast.
So though there is no criminal this thing, but summary suits are pretty fast. Pretty
fast. Even the commercial courts and all that. But then there's a cost again.
Correct.
There's a court fee involved, and it's not that one order comes and that's over, because there could be appeals, first appeal, second appeal. So it's a long process. So we just hope that government probably does it just for one amount and doesn't keep it absolutely clears off.
I would love to take more questions on this, but as we are short on time, I just want to thank you all. We have a lot of questions in the question answer box. So we will take some time. I'll just take you through the questions, and I would direct it to you. The questions are, anybody who wants to ask a question directly to one of the panel members can also raise your hand. You have an option. How are you seeing? Okay, one question which has come in from one Mr. Abhishek Anand is that are we seeing there are a lot of insolvencies which are happening in travel sector? Are we seeing insolvencies rising in it? Bhavesh, would you want to answer? You have recently have a huge flow of claims on this sector. What are your views on travel sector?
Yeah, so transportation, as we call it, so travel, tourism, hospitality related, these sectors are going to be obviously going to be badly impacted, I would say, till at least H1 2021 to be on the on the baseline side, So the appetite is going to be less, and there is going to be definitely an increase in insolvencies and bad debts and loss of accounts receivables. We've already started seeing claims, in India, and in fact, this claim started. Some of them started even pre-COVID. So anyway, it's a sector which you have to watch out for.
Okay. Okay. Thank you, sir. This is one question from Mr. Shishap, where he says, "Do you have?" I think the question is not very clear. He said, "Countries which have no impact, industries which are less impacted, and COVID caused any high premium cost for cover?" The answer is yes, obviously. Arun, would you want to answer this? Do you have any set of countries which have had no impact, or industries which have got very less impact? Which I think Bhavesh already answered. So maybe you can.
No, I don't think. Yeah. So I'll come fast to that. I don't think there's any country that's not been impacted by it. But what to go to the second part, I think it's not about just hiking rate or just as a consequence of COVID. It's about balancing it has to be balanced. The measures have to be balanced. Therefore, the rate that you pay will be commensurate with the risk you take. So earlier, the risk environment and the landscape was not the way it was. And traditionally, India has been a low claim, although they pay late, but then the claims are not so high. Now the scenario has changed. Therefore, there has to be rationalizing of rates. So to come to your point about which country or which sector has not been affected, I'm afraid that wouldn't be an answer that I could give, because almost every sector and almost every country we've seen across our region has been affected.
Okay, this comes from one of the clients who says, Mr. B.S., how cumbersome is to take approvals to make sales exceeding allowed limit, because month end there are always pressures and there is an immense urgency. What are your suggestions? How should they take care of such a situation? Bhavesh sir, would you want to take that, or I'll ask Subhash sir if he can assist with that? Because month end, sometimes there are pressure, but not in case of exports, probably more in case of domestic business. Bhavesh sir, your comments on last moment limit increase?
Yeah, so the way I understand this question is anyway, he's supposed to, hopefully the credit limit is taken on the peak exposure based on last, a year or couple of years of experience, And if there is something which is kind of, seasonal in nature, then yes, as insurers, we do give seasonal credit limits, to take care of these seasonal peaks like Diwali sales and, Christmas sales, etc., etc.
So what you're saying is that it has to be pre-planned. There cannot be like suddenly it does take time. Yeah, it's not straightforward. Okay. One Mr. Weber Merchant is asking that his question is, if an order is made particularly for a customer and if the customer declines to take delivery, will that be covered under trade credit? Obviously, this is the case of pre-shipment risk. What is the view of insurers on this? Does insurers look at such claims and pay? Maybe I can answer it, because I think ECGC does not have a pre-shipment risk cover, but in other places also it is pretty restricted unless the goods leave your possession. And once it has left and then the buyer refuses to purchase, refuses to pick up the goods, then insurers do assist with debt recovery and the claim is accepted, as Dr. Seema Kumar was suggesting, that there have been cases where the payment terms have been changed, the insurers and the debt collection agency have assisted on it. Another question is, our major customers are government companies. This comes from Mr. Devesh Maheshwari. Now, none of the insurance companies are offering credit insurance for supplies to them. How do we resolve this situation if companies just say we cannot file case against government companies, hence no insurance for them? I think this is, Bhavesh sir, any view on this? Will you cover government companies?
Well, I think as a credit insurance industry, we have always been covering government-owned limited company form of organizations, So just to clarify, if there is, what we have traditionally not been covering is pure sovereign risk, domestically with extended arms of the government or ministries, etc., etc. So if it's a limited company form of organization, and provided we have risk appetite in terms of granting a credit limit, we have been covering government companies.
I think one very, so I think Arun also have the same view, and obviously ECC has an export, so obviously they would not be talking about it. One very interesting question, and I think I would want answers from insurers. Eddie has already spoken about it. This again comes from Mr. Devesh Maheshwari. He suggests, what is the payout ratio of the insurance company against the claims? Eddie suggested that almost 97% of the claims are paid when he talks about his experience. Arun, what is your ratio?
So as far as we are concerned, I would tend to agree with Tyler, because if it's a bona fide claim, it's 100% payout. So there's no reason why we should not be paying the claim. Now, in terms of traditionally,
would you be putting in terms of some number for this payout ratio?
Well, in terms of payout ratio, I would imagine that the claims received to the claims paid out would be clearly in the range of 75 to 80% easily. I mean, the 20% that's not would be for clear reasons. I mean, our endeavor is to pay. In fact, in the times, in fact, it is the best. It's the best advertisement for us anyway. If you pay claims,
your view on this? Any number you want to put?
No, I
claim
would
payout
not.
ratio?
I would not like to put a number to it, but I'll agree to, like, for example, what Eddie said in terms of count. I think we would be in that region, globally everywhere, and you have to understand that it's uh, uh, what is a bona fide claim should not be part of the common denominator. So if you look at whatever is payable
Will be
is
paid.
always paid.
Okay. I think
Okay.
Subhash sir would
I would
be.
just say something,
Yeah.
Akshay. Maybe it's just higher for Marsh clients.
Okay. Yes. Subhash sir, I
Yeah,
think
yeah.
you would be in a position to give a
Yeah.
better perspective on this.
I would also not like to attach any number to this, but I would like to say that any bona fide claim, any tenable claim is always payable and paid by ECGC. We are for claims, and even where there are certain gray areas also, when we process the claim, we try to be positive and look what are the circumstances that can come in the to support the customer. So our effort is always to settle claims in favor of our clients. Only the cases where there is a clear-cut lapses, serious lapses, then only claims are rejected.
I think any number you want to put on this,
If I consider representations also, because sometimes claims are rejected and they are represented also, then it is around 80% of the claims are paid.
That's quite a huge number, sir. That's quite a huge
Yeah.
number. Yeah. Okay, I just want to make a small announcement because we are 6:07 now. We started at 5:02, so we are already past the time. I want to thank all the participants who have come in, as well as the panelists from Marsh. I would want to answer all the questions. So if panelists are okay and people who are listening are okay, they can remain. We will finish these few questions. Can we do that?
Yeah, we're good.
Yeah. Okay. Another question comes in is consignments are delivered on credit to customer, payment received timely. All of a sudden, one of the consignment payment is failed by the customer. How does insurance company look at the claim and how is it settled? Eddie, would you want to answer this? The question is,
We're talking consignment stock. Consignment stock. Well, there has to be a consignment stock agreement in place. And that has to be endorsed to the policy. And then there are some basic rules, like you've got to have a trigger for when something is due for payment, and you've you've got to regularly, in theory, audit things, etc., etc. But there's a basis on which it's dealt with. But if you follow the rules, then your claims get paid.
Thank you. I think one very important question which has come up is force majeure clause and impact on trade credit claims. What is the impact on claims force majeure clause? In case of force majeure, are claims paid or insurers are off their liability? Any comments from you, Eddie?
Sorry, from me, I would just say we've explored this with insurers, and insurers pay against the events they are insuring for. They pay for default. In the event of default, a claim is payable. In the event of insolvency, a claim is payable. In the event of a political risk event, a claim is payable, and that is what they have all said to us. So force majeure is more about your contract and what may happen with that contract, and subsequently what may or may not be allowable under that contract. And then you've probably got to go to the courts to get that resolved. Because if there's a dispute, then insurers will always say, "We'll resolve the dispute," and then when it's resolved and it's sorted, then we can look at it. And that's my view.
Thank you. Anybody from the panel would want to add to it?
Nope.
Oh, I concur with
Eddie.
Okay. There is a question from Mr. Yash Moga where he asks, credit managers will be more focused on quality of buyer risk, and at the same time, business managers will be keen to rebound the business and expect credit to support. How insurers can support to take a balanced approach. I would want to discuss this with Arun and then with Bhavesh. What are your views?
Good question. We will be supporting business. Okay, let's not get away from that fact. All we're trying to tell you, and the approach we've been doing for the last 3 months is look at limits or exposures that you don't need. And that's really where the focus of reduction or rationalization or whatever you want to call it. But if you have a bona fide business and a bona fide business to do, and you're consuming those limits, we will be supporting that. I think there is no two ways in that. But again, we'll have to assess the quality of the buyer before actually looking at that risk as it was before. So two things will happen. One is the fact that, is there any deterioration in the quality of the buyer? If there isn't, are you trading in the same levels as you used to? And in that case, if both the tick boxes are checked out, I think we should be good to go. But then, as I said again, these two are very critical. So you need to demonstrate business being done with the risk that the exposure that you want.
Thank you. I because of paucity of time, I'll take the last question and then we can summarize. This is with respect to one query which keeps on coming from clients. As you know, because of COVID, the projected turnovers have gone haywire, and many people have ended up achieving 50 or 60% or 40% of their projections. And the query is that, and this comes from Mr. Mahesh V, that in such a situation, will insurer be also able to adjust to a lower premium and give some additional discount to their clients? That is lower than the minimum and deposit. Bhavesh sir, would you want to take this?
Yeah, it's a very difficult question to answer, and I think the answers will be more case specific, and situation specific, depending on what the sectors and industry and buyer profiles are, So you have to also appreciate the other side, I mean, to the corporate asking this question, that, there will already be potential claims lodged, or there will already be, substantial huge overdue positions, So it's and the premium which you pay is always a fraction of the claims, which are going to come out of an credit insurance contract, because the limit of indemnities are always 30, 40, 50, 60x, of what the premium is paid, And anyway, even if a single claim is paid, the entire minimum deposit premium is deemed earned, So that's how most of the policy contracts also go, But in a very, very highly deserving and genuine cases, we can always look at it on a case specific basis.
Okay.
Yeah, Mr. Akshay.
Yes.
Yeah, I want to add, apart from what Mr. Bhavesh said, that case-to-case basis, ECGC has already come out with some measures to help export our policyholders in these times. That is to reduce the fee-based that collection, like processing fee and the fee required for the credit limit processing. All these have been credit limit processing fee has been waived, and processing fee for the proposals has been reduced to 50%. That is one measure which we have already taken. Secondly, we have given a lot of discretion and freedom to the exporters to take mitigating action in cases where goods are not delivered yet, but they are lying on the port. And so they can take the action for resale of the goods or bring back the goods. So as to avoid any time losses and freeze their losses at that time. So yes, we have come out with measures where their expenses to some extent can be lesser, and secondly, they can take timely mitigating actions.
Thank you, sir. I think now it is time to say the last few words. I thank you all, Arunji, Bhavesh sir, Subhash sir, and Eddie, Tyler, for taking out time. It was a pretty interesting session, I believe, and we had so many questions, and I believe this is, if required, we may call you again for an elaborate session. This presentation, this discussion would be saved by Niladri and would be put up on YouTube as well as on our website. You can maybe refer to it. We had huge, almost 200 guys joining in, so it was pretty successful. A lot of questions, Thank you once again, and thank you to all the participants who took out time to join in. Thank you once again. Have a great weekend. Stay safe.
Thank you.
Thank you.
Thank you.
Bye.
Thank you,
Bye,
actually.
everybody.
Thank you, everybody. Have a great weekend.
Bye-bye.
Bye-bye.
Bye.
Likewise.